3 AI systems. 1 mission. Claude. Gemini. Groq. All 3 received the same prompt: scan every stock on Canadian markets. Market cap $100 million to $2 billion. Revenue growth above 25% for 3 consecutive quarters. Analyst coverage 5 firms or fewer. Founder ownership above 15%. A secular tailwind lasting a decade. Improving gross margins. 18 months of cash runway. A defensible moat. And a concrete catalyst in the next 6 to 12 months. Each system ran independently. Each returned 5 names. 12 stocks total, some overlap, all worth examining. But here is the thing about AI-generated stock lists: they are the starting point, not the finish line. Today, you are going to watch the entire process, live. From 12 candidates to a portfolio of 7. Let's get into it. Before we name a single ticker, let's talk about how we found these names, because the process matters as much as the picks. 9 filters. Each one designed to eliminate noise and surface only genuine high-conviction opportunities. Filter 1, market cap between 100 million and 2 billion Canadian, small enough that institutions haven't crowded in, big enough to be a real company. Filter 2, revenue growth above 25% for at least 3 consecutive quarters. Not a one-quarter wonder, a trend. Filter 3, analyst coverage of 5 firms or fewer. If Bay Street already loves it, you're already late. We want to be early. Filter 4, founder or insider ownership above 15%, we want people with real money on the line. Filter 5, a secular industry tailwind lasting at least 10 years. We are not chasing trends, we are riding megatrends. Filter 6, gross margin improvement, the business must get more efficient as it scales, not less. Filter 7, at least 18 months of cash runway, no emergency dilution surprises, no gun to management's head. Filter 8, a defensible competitive moat, patents, certifications, network effects, data advantages. Something that makes the business hard to copy. And Filter 9, a concrete catalyst in the next 6 to 12 months that the market hasn't fully priced in. We need a reason for the stock to re-rate, not someday, soon. 9 filters. 12 candidates. Let the elimination begin. The 12 names that emerged from across the 3 AI systems: Propel Holdings, Firen Technology Group, Well Health Technologies, Patriot Battery Metals, Eldorado Gold, Electrovea, Kits Eye Care, Covalent Technologies, Vital Hub, entered as WHI, a typo we'll come back to, Kraken Robotics, Zedcor, and Logan Energy. 12 names. 9 filters. 1 framework. Let's start eliminating. With 12 names on the board, the first job is brutal but necessary: find the 2 with the lowest growth potential and cut them immediately. We scored all 12 on 5 dimensions: revenue momentum, earnings trajectory, business model durability, industry catalysts, and gross margin trend. 2 names fell to the bottom, and once you see the data, it is not close. First eliminated, Westshore Terminals, ticker WHI. This is an income stock wearing growth clothes. Revenue and net income both fell in 2025. Analyst consensus projects revenue declining approximately 2% annually over the next 2 years. This belongs in an income or infrastructure portfolio, not a high-growth fund. Second eliminated, Covalent Technologies. Revenue grew just 5.3% in 2025, the slowest in our entire pool. Worse, gross margins contracted from 61% to 53%, moving in the wrong direction. No scale advantage is emerging. 10 stocks remain. 10 candidates. And now, a shift in perspective. We are no longer just screening, we are building a portfolio. That means asking harder questions: does this company belong in this specific fund? At what weight? And what happens if it is wrong? Let us go through all 10, and make the calls a real fund manager would make. Propel Holdings, core anchor at 25%. Zedcor, highest conviction at 25%. Kits Eye Care, profitable inflection at 20%. Electrovea, break-even achieved at 15%. Well Health, reduce weight to 7%. Kraken Robotics, small position at 8%. 3 more eliminations. Eldorado Gold, Revenue grew 38% in 2025, but almost entirely because gold prices rose, not because the company produced more gold. If gold reverses, that growth collapses to zero or negative. A growth fund has no room for commodity price wrappers. Patriot Battery Metals, zero revenue, exploration stage. The James Bay Lithium project is world-class. Volkswagen's $69 million strategic investment confirms that. But cash flow is at minimum 5 years away. This belongs in venture capital, not a high-growth fund. Logan Energy, early stage, Montney formation, just entering profitability. Growth companies should have operational leverage, not commodity leverage. LGN is out. And then, something unexpected. This is the part of the story I was not expecting to tell. During our data entry phase, one of the original 12 tickers had been logged as WHI, which was Westshore Terminals, the coal terminal company we eliminated in round 1. But when we ran the broader market scan looking for high-margin recurring revenue growth stocks, we found VitalHub. Ticker VHI. And immediately understood, this was almost certainly the name that should have been in the pool from the beginning. Accidental discovery. Real conviction. The numbers are exceptional for a company most investors have never heard of. Revenue grew 59% in 2025. Gross margins sit at 80%, the highest in this entire portfolio. Cash on the balance sheet is 124 million Canadian against only 1.6 million in debt. VitalHub sells software to hospitals, patient flow optimization, bed management, operational visibility, workforce automation. Over 1,000 hospital clients across the UK, Canada, and Australia. Products so deeply embedded in daily hospital operations that switching them out is effectively impossible without a multi-year project. The valuation gap is one of the largest we have seen. The stock trades near $7. The analyst consensus target is 13.47. The DCF fair value is 23.60 per share. 14 analysts cover this stock. 6 say buy. None say sell. VHI earns the final spot, and arguably the highest strategic fit of any name in this portfolio. 7 stocks. Each one passed every filter. Each one earned its place. Here are the deep dives, in order of portfolio weight. Propel Holdings is our highest conviction position, the anchor of this portfolio. The thesis is simple: 60 million people in North America are declined by traditional banks every year. They need credit. They pay for it. Propel's AI decides who gets it, at what rate, with what terms. 590 million in revenue. 60 million in net income. Growing 31% per year. Trading at 6.3 times forward earnings. Let that sink in, a profitable, high-growth fintech at a valuation you would expect from a dormant utility. The moat is the data. 12 years of loan origination, repayment, default, all feeding an AI model that improves with every single transaction. A competitor cannot buy that history. They have to earn it over a decade. And now, Propel has a banking license in Puerto Rico, unlocking deposit taking, new product lines, and an entirely different margin structure. Risk level, medium. Subprime portfolios are sensitive to recessions. But the co-founders have managed through credit cycles before. 9 consecutive dividend increases. They are not reckless operators. Zedcor is the standout discovery of this entire process. The one name that, when you look at the numbers, makes you ask, why hasn't this already been discovered? 79% revenue growth. 40% EBITDA margins. On a mobile security tower business. The model is elegant: deploy proprietary AI-equipped camera towers to construction sites, utilities, critical infrastructure. Charge monthly recurring fees. The hardware is the moat: you cannot download a competitor's tower. They have one in Canada. Now they are in the early innings of the United States expansion, a market roughly 10 times the size of Canada's. The flywheel: once sites are placed, revenue is near automatic. The unit economics get better with every tower deployed. Risk level, medium. Execution risk on US expansion. Capital intensity as the fleet scales. But if US expansion mirrors the Canadian trajectory, the re-rating from this level will be significant. Kits Eyecare is exactly what a growth fund wants in a consumer position, a company that has figured out how to grow revenue 27% while simultaneously improving profitability. Most e-commerce companies choose between growth and profitability. Kits is choosing both. They make their own lenses. They control the supply chain. The margin structure is getting more powerful with every order. Think Warby Parker, but vertically integrated, profitable, and Canadian. The Canadian eyewear market is enormous and surprisingly sticky. Once a customer trusts you with their prescription glasses, they rarely leave. The lifetime value of a kit's customer compounds every year. Risk level, medium-low. Established revenue base, improving unit economics, low debt. The main risk is U.S. expansion execution. But the Canadian foundation is solid. Every investor knows about the battery boom. Most have lost money on it. ELVA is the exception because it is not a pre-revenue promise. It is a company that just crossed the profitability threshold for the first time in its history. 43% revenue growth. EBITDA more than doubled. This is the year ELVA stopped burning cash and started generating it. The product, long-life lithium iron phosphate battery systems for industrial forklifts and data center backup power. Not flashy. Entirely essential. The moat is certification. Industrial customers run qualification cycles that can take 2 years. Once ELVA is the qualified supplier for a major distribution center, they do not get replaced at the next contract renewal. The switching cost is the production downtime risk. Risk level, medium. Small company, competitive battery market, dependent on a few large customers. But the profitability inflection is real, and the data center tailwind is a 10-year story. We covered the discovery story. Now let us talk about the investment case. VitalHub sells software to hospitals, not glamorous, completely essential. Their systems track where every patient is, where every bed is, and what every clinical team member is doing, in real time, across some of the most complex healthcare systems in the world. When revenue grows 59% and gross margins are 80%, you have a fundamentally sound business model. The only drag on earnings has been integration costs from 2025 acquisitions, a temporary friction, not a structural problem. And critically, this is not AI-disruptible software. The regulatory frameworks, the clinical validation requirements, the decade of patient outcome data built into these systems, no large language model can walk into an NHS hospital and replace a VitalHub bed management platform overnight. The valuation discount is the opportunity. As integration costs normalize through the second half of 2026, the earnings picture clarifies, and the multiple should re-rate dramatically. Well Health is the most debated name in this portfolio. The bull case is enormous. The execution risk is real. We carry a smaller position, and watch it closely. The scale is already there, 5.7 million patient visits, over $1 billion in revenue, an AI diagnostic suite in active deployment across physical and virtual care settings. Canada's healthcare system is structurally underfunded and overloaded. Well is the private sector's answer. The risk, well, has grown primarily through acquisitions, and the debt load is real. The AI modules are promising but not yet commercially scaled. Haim Shabatzi is a visionary founder, but vision alone does not service debt. We maintain a 7% position, enough to participate if the AI thesis accelerates, small enough to manage if it does not. Kraken Robotics makes the sonar and the batteries that go inside the underwater drones that protect the cables, the pipelines, and the military assets that modern civilization depends on. And they have a certification that no competitor has replicated. Their Sea-Power battery is the only subsea battery approved by the U.S. military for operation at 6,000 meters depth. The 2026 revenue guidance of $165 to $175 million is not speculation, it is based on a signed acquisition, Covelia Group, a UK underwater technology company, closing in the second quarter of 2026. The revenue is effectively locked in. Kraken is the picks and shovels play for a defense category that is growing regardless of which political party runs any Western country. Underwater infrastructure protection is a bipartisan priority on every NATO member's agenda. Risk level, medium-high. The valuation already reflects considerable optimism. Concentration in Anduril means Kraken's fate is partially tied to Anduril's. We carry a smaller position, strategic exposure to the defense tech theme without overconcentrating. Here is where we started. And here is where we ended up. 12 candidates. 5 eliminated in 2 rounds. VitalHub discovered through a data correction. 7 final positions. Portfolio construction rationale: 5 distinct sectors, no single industry dominates. The 3 TSX anchor positions, Propel, Zcore, and Kits, carry 70% of the weight. 4 satellite positions carry the remaining 30% for asymmetric upside. Average revenue growth across the portfolio, approximately 47%, well above our 25% threshold. This is not a collection of lottery tickets. Every company in this portfolio is either already profitable or at the profitability threshold. Entry strategy: 3 tranches. Tranche 1, establish now, 40% of your total position. The thesis is confirmed, so enter a foothold. Tranche 2, validate, in 1 to 3 months, once Q1 2026 earnings confirm trajectory. That is 35% of your position. Tranche 3, conviction, in 6 to 9 months, deploy into the strongest performers. That final 25% goes to the names that are executing. And for Canadian investors, run this portfolio inside your TFSA first. 3 years of small cap growth, completely tax-free. Total entry cost across 7 positions in 3 tranches at standard brokerage rates, approximately $105. For a $10,000 portfolio, that is 1.05%, the only fee that does not compound against you. Let me tell you what this process actually taught us. We started with a 9-point framework and ran it through 3 separate AI systems. We got 12 candidates. We stress-tested every single one. We eliminated 5, not because they are bad companies, but because they do not belong in a high-growth portfolio with a 3-year mandate. We discovered a 7th name, VitalHub, that emerged from a data entry correction and turned out to be one of the strongest fits in the entire universe we screened. That is real research. That is how Edge is built. The 7 names, PRL, ZDC, Kits, ELVA, VHI, Well, and PNG, represent 7 different risk profiles, 7 different industries, 7 different stories. Together, they form a high-growth portfolio designed to outperform the TSX Composite over a 3-year holding period, while remaining diversified enough to survive the inevitable surprises along the way. The opportunity exists because most people are not looking. Analysts do not cover these names. Institutions cannot buy enough shares to move the needle. The inefficiency is the edge. I want to be clear, everything in this video represents personal research and independent analysis. This is not investment advice, and it is not a recommendation to buy or sell any security. I am sharing a thinking process, the same way you might share a research paper or a case study. All investing involves risk, including the total loss of your principal. Past growth rates tell you nothing guaranteed about future results. Please read the financial statements yourself. Please consult a licensed financial advisor before making any investment decisions. If this analysis was useful, subscribe. Drop a comment below. Which of these 7 names are you watching? The best investors I know learned by sharing their thinking, not hiding it. See you in the next one.